Hallo, mein Name ist Tobias Kunkel von Investment Strategy und Research. Neben mir steht Sébastien Lagarde von Mandarine Gestion. Ich hoffe, ich spreche es richtig aus. Er managt den Mandarine Gestion Global MicroCap und den Mandarine Gestion Europe MicroCap. You launched the Europe MicroCap fund back in 2013 and it delivered a very strong performance in this time, and now you have reached a volume of about 150 million euros. Can you describe the approach of the fund and where's the difference to its competitors?
Yes, so this fund is a very specific fund because it invests in the really smallest companies in the European markets, let's say the last 2% of the total market cap. So it's perhaps one of the few funds dedicated to these pan-European very small companies, and perhaps that there are only maximum 5 different funds which invest broadly in Europe in these very small companies. And my approach is that you have in this investment universe lots of companies, around 4,000. Each single story can be very promising because these companies on average deliver more growth, and you have lots of market inefficiencies which gives us lots of opportunities in terms of valuation. But you have always to keep in mind that these companies are poorly diversified, so they are risky, and that's why I have an approach of a portfolio which is really well diversified, and currently I have 175 different stories in my fund, and it's perhaps the main difference versus my competitors, let's say.
Now you launched the Global MicroCap Fund in 2016. Is it the same approach, or is there any difference to the MicroCap, or is it just the universe? Which difference?
Yes, there are no differences in terms of investment process. It's exactly the same story. Microcaps, never mind if it's in Europe, in the US or in Japan, these companies are very small, they offer lots of growth, they offer more market inefficiencies because nobody cares about these very small companies, so you have the same story in all regions. The only difference is that in Europe you have 4,000 microcaps, but worldwide you have more than 20,000 different stories. So I can put even more different stories in my portfolio. So as I mentioned, it's the European fund. I have currently 175 different companies, and in my global fund I have currently 335 different stories. So you see, I have really a very well diversified portfolio with very decent weight on each single story. And the good news currently is that you know that the macroeconomic conditions or the economic cycles are well synchronized between the different regions, and we have lots of growth in North America, in Europe, and in Japan as well. So currently the landscape is very good for microcaps in all regions.
In microcaps there is a lot of risk sometimes. How can you handle this risk, and can you describe the big risks in microcaps?
Yeah. The main risk for these companies, you know, when we say microcap, micro means that these companies are small. They are small on the stock market, but it means also that they are small in their activities. So generally they are poorly diversified. They try to develop a new type of service or product for the clients, and they try to develop some new market niches where they have a strong power, but it's always some niches, which means that if an accident occurs in their business model, they are poorly diversified, so it can be a nightmare for some of these companies. So we have always to keep in mind that these companies are poorly diversified, so which means that each single story is risky. And to counterbalance this risk, my approach is to have a very decent weight on each single story. So in my European fund, generally I have a weight of 0.6% for each company which is included in the fund, and currently in this fund the biggest weight is 0.85% only, so very decent weight on each story. And for the global fund, the biggest weight currently in my portfolio is only 0.45%, and the average weight for all companies in my portfolio is only 0.3%. So that's my way to counterbalance the single risk that we take for each company in the portfolio.
So you have really a big number of companies in your portfolio, and do you know all these companies really very good? Do you visit all these companies, or how do you manage to research all these companies?
So in fact my secret is that I have been working on the stock markets for 20 years, and I started as a quantitative analyst, and I discovered that the quantitative scoring approach work very well for these very small companies because there are more market inefficiencies in this investment area. So I would answer that my quantitative approach gives me a first opinion on all companies in my investment universe. Once they are included, if they have a good score in my systems, if they are included in my portfolio, then we make, on a daily point of view, a fundamental review on what happens for each of these companies in our portfolios, and we can react to the news flow and so on. And we try to make a maximum of company visits and so on. And for instance, last year we met the management of around 200 different companies which are owned in Mandarine Europe MicroCap or in Mandarine Global MicroCap.
When do you sell a stock?
So there can be some different type of reasons why we sell a stock in our company, but the general rule is that if something wrong happens in the business development of the company, so if an accident occurs, if the company faces strong troubles in one factory, or if they lose one big customer, or never mind where the accident comes from, even if the stock price goes down very fast, I prefer to sell, because generally for these companies, as they are poorly diversified, if something wrong happens, it's just the beginning of a series of troubles. So even if the stock price goes down very fast with the bad news, I prefer to sell fully the story in my portfolio and to replace it by another one. But there are other reasons why I can sell some companies in my portfolio. If one company reaches a market cap of 2 billion euros, I have to sell it because it's not a microcap anymore. And more generally speaking, when some stocks underperform for a long period of time my investment universe, I can sell. So it's like a stop loss selling policy, I would say.
Can you describe the fundamentals of your portfolio and compare it to the MSCI World Index?
So if we look at the global fund, I would say that in this fund, as I mentioned, I have more than 300 different stories. So it can, lots of people think it's a really big number, but you have to keep in mind that in my investment universe, there are more than 20,000 different stories. In my benchmark, which is the MSCI World MicroCap Index, there are nearly 6,000 different stories. So 300 is only a very small part of this huge investment universe. which means that I have a strong bet in terms of stock picking. Currently, the active share of this fund is nearly 92%, so only 8% of my portfolio is included in my benchmark. So I have lots of stock picking bets in this portfolio, and to control the total level of risk of this portfolio, I try to reduce all other type of risk. So if I can have no macroeconomic risk, I try to do it. So for instance, I try to have really few bets in terms of countries, of sectors. So just to give you some examples, in the investment universe or in my benchmark, there are around 1/4 of European companies, so I have 1/4 of European companies in my portfolio. There are 28% of Japanese companies. I have 28% of Japanese companies in my portfolio, and so on. So I have really few bets in terms of sectors and countries in this portfolio.
What about the fundamentals like price book ratio or dividend yields or things like that?
Yeah. Generally, these companies deliver lots of growth and they have to finance their growth, so they don't distribute lots of dividends. And I prefer some companies which have lots of projects and prefer to reinvest all their cash flows in the future growth of the company rather than distributing it to their shareholders. So generally, the dividend yield offered by these companies is 50% less than the large caps on average. But the good news is that these companies offer really more growth. So currently we forecast around 20% of growth for the worldwide microcaps versus only 10% of growth for the worldwide large caps. So twice the pace of growth versus the large caps. But the good news is that the global valuation, so if you look at some price earning ratio and so on, it's lower than for the large caps, just because these companies are poorly covered by financial analysts and so on. It's the last 2% of the total market cap, and nobody cares about these companies, which means that you have lots of market inefficiencies, and which means that you can build a portfolio which have a very good mix of growth and decent valuations.
What do you generally expect for the stock markets in the next 2 or 3 years, and do you hedge any positions or include your personal market expectation in the portfolio?
So the answer is very simple, it's no. I have never a view on what will happen on the stock markets tomorrow or within the next 12 months, just because it's mostly a matter of inflows and outflows in or out of the market. So I have no view on it, but what I know is that these very small companies create lots of value for their shareholders on the long run, because they innovate a lot and they deliver lots of earnings growth. So on the long run, I know that these companies create lots of value. So I never wonder if the markets will go up or down tomorrow. I know that on the long run, these companies deliver and create lots of value, so I prefer to be always fully invested. So for these two funds, Mandarine Europe or Mandarine Global Microcap funds, I am always invested at 99%.
And the last question, personal question, what was your biggest mistake or your biggest loss in your financial life, and what did you learn from it?
For sure, you know, I have been managing some European microcaps for more than 13 years now. I started in 2005, so I had to survive the financial crisis in 2008. It was painful for microcaps because these companies are less liquid, so the fact that all investors wanted to sell any type of financial assets had lots of impact for microcaps. MicroCap, so it was a hard period of time for my fund as this period of time, and from a single company perspective, I have had in the past lots of accidents. That's the rule of the game. I invest in some very small companies that are poorly diversified, so for one part of them there can be some accidents, which means some strong decreases on the stock market. Last year my biggest mistake was a Norwegian company in which I was invested, and we were waiting for a big contract from the Norwegian defense, and finally this contract was given to a competitor, and when it was announced the stock price went down by around 50%. So you see, each single story is very risky, but the good news is that when these companies deliver, it can be really strong successes. So on the reverse side, last year for instance, I was invested in a very small exploration company, oil exploration company in the UK. This company is called Serica Energy. They announced a big deal for them with BP, and the day where they announced this deal, the stock price went up by 150% within one single day.
Okay, so it was a great pleasure to meet you here. Thank you very much. Bye bye.
Thank you.